Welcome back to another deep dive. You know that feeling around tax season? It can sometimes feel like you're wrestling with a Rubik's Cube, but blindfolded.
Yeah, definitely. All those forms, the numbers.
Right. And you're always wondering, did I miss something? Or worse, did I mess something up?
Hmm.
Well, think of us as your guides today. Our mission is simple. Take your sources, basically the IRS's own guidance on what's taxable and what's not,
Hmm.
and break down the really important bits. We want to make it super clear what you have to report, what you might not have to report, and crucially, where those, hidden tax-saving gems might be.
Exactly. And that's the core of it, isn't it? Because getting the stuff right isn't just about ticking boxes for compliance.
What?
It's about empowering yourself, giving you the knowledge to handle your finances better, and maybe, just maybe, avoid paying more tax than you absolutely need to.
Yeah, paying less tax sounds good to me.
It shifts the whole mindset, really, from obligation to opportunity.
Okay, let's dive right in then. We got to start with the basics, right? What even is income, according to the IRS?
Good starting point. So the sources say income can be money, obviously, but also property or services you receive.
Huh?
And the fundamental rule is pretty much anything you get is taxable unless there's a specific law that says it's not.
Ah, so that unless is the important part.
That's where all the action is, yeah. Taxable income gets reported and taxed. Non-taxable income. Well, sometimes you still show it on the return, but it doesn't actually increase your tax bill. It's tax-free money.
That's a key difference. What about tricky timing things? Like getting a check right at the end of the year.
Yeah, constructively received income. Basically, if the money is available to you, even if you don't physically grab it or cash the check until January.
Like it's sitting in your mailbox on December 31st?
Exactly. The IRS says you constructively received it in December, so it counts for that tax year.
Got it. Control matters.
Right. And then there's assignment of income. You can't just tell your boss, hey, pay my rent directly instead of paying me to try and skip the tax. It's still your income. You earned it.
Makes sense. So you can't just redirect it to avoid tax. What about getting paid up front for something you'll do next year, advance payments?
Generally, yeah, those are income in the year you get the cash. There are some complex accounting exceptions for businesses using the accrual method, but for most individuals,
Cash is king.
pretty much. You get it now, it's income now.
Okay. So this all kind of boils down to you get forms like the W-2, 1099s. Those are vital.
Absolutely crucial.
But you are ultimately responsible for reporting all your income, even if you don't get a form or if a form looks wrong.
That's a big one. Don't just rely on the paper you receive. You know what you earned. And if Social Security and Medicare weren't withheld properly, you might even need an extra Form 8919, to sort that out.
Good reminder. Okay, let's shift to where most people get their income,
Yeah.
the job. Let's talk compensation and then those fringe benefits you mentioned, where the savings are. First up, bonuses, awards.
Almost always taxable. Straight up. And that includes non-cash stuff, too. Like, you win a trip. Yeah, but the fair market value, the FMV of that trip, that's taxable income.
Okay, no free lunch or a free trip, I guess. What about advance commissions? If you get paid ahead and then maybe don't earn it.
Taxable when you receive them. Now, if you have to pay it back in the same year, you got it.
Ah, okay.
You just reduce your income for that year. Simple, best case.
But if it's later, like next year,
Then it gets a bit trickier. It becomes an itemized deduction on Schedule A. Still helpful, but maybe not quite as good as reducing income directly.
gotcha. And things like severance pay or payouts for unused vacation time.
Also taxable as wages, subject to all the usual withholdings. For federal folks, there's a specific rule: repay accrued leave in the same year if you get rehired. You can actually reduce your gross wages. Need proof, though.
Interesting detail for government employees. And what about digital assets? Crypto is pay.
Yep, becoming more common. The fair market value on the day you receive it, say, Bitcoin is treated just like regular wages.
Yeah.
Taxable goes on the W-2.
Okay. And even getting paid with a promissory note can trigger tax,
Right.
depending on the details?
Right, depends if it's secured, readily valued, things like that. It affects when you report the income.
All right, now for the part you flagged as the good stuff, fringe benefits.
Yes. This is where the real tax-saving action often happens, sometimes without people even realizing it. The rule is fringe benefits are taxable unless the law specifically excludes them. And those exclusions, they're powerful.
Okay, hit us with the highlights. What should people look out for?
Big one, health benefits.
Always important.
You've got health FSA's flexible spending arrangements, money you put in through salary reduction, and the reimbursements you get for medical costs. generally not income. For 2024, that limits $3,200 you can put in tax-free.
That helps offset costs.
Definitely. Then HRA's health reimbursement arrangements. Similar idea, employer-funded reimbursements are generally tax-free.
Okay.
And the STAR, HSA's health savings accounts. These are like a triple tax haven.
Triple. How so?
1, contributions can be tax deductible, or if your employer contributes, it's not income to you. 2, the money inside grows tax-free. 3, withdrawals for qualified medical expenses are completely tax-free.
Wow.
Yeah. And a key strategy here, if you can swing it, is pay current medical bills out of pocket and let that HSA grow as an investment vehicle for future health costs or even retirement. It's incredibly powerful. Even rolling money from an IRA to an HSA once can be tax-free.
That's a serious long-term planning tool hidden in health benefits. Okay, what else?
Adoption assistance. If your employer helps with adoption costs, you can often exclude that help from your income. Huge for families adopting.
Oh, you wonder what?
Athletic facilities,
Yeah.
that free gym at work, if it's on premises, and mostly for employees,
Not taxed.
not taxed. Good for your health, good for your taxes. But if they just pay for your membership at a club down the street, that's usually a taxable income.
Ah, location matters.
It does. Then de minimis benefits. These are small, occasional things. Think free coffee, occasional personal copies, the company picnic.
The holiday turkey again.
The holiday turkey, yes. These are generally not income because they're just too small and impractical to track. But and this is crucial,
Right.
cash or cash equivalents like gift certificates or gift cards, always taxable. Doesn't matter if it's just $10 or $25.
Huh. So the form matters. Turkey good? $25 gift card bad? Well, taxable.
Taxable, exactly. Important distinction for both employers giving gifts and employees receiving them.
Good to know. What else?
Dependent care benefits. Up to $5,000 a year, or half that if married filing separately, provided by your employer for dependent care. Excludable. Big help with childcare costs.
Definitely.
Educational assistance. Up to $5,250 per year from your employer for education. Tax-free. Great way to upskill without a tax hit.
Nice.
Group term life insurance. The cost your employer pays for the first $50,000 of coverage. Not income to you. Another often overlooked benefit.
Above 50K is taxed, though.
Usually, yes. Though there are some exceptions, like if you're disabled or the employer's the beneficiary.
This list is amazing. It really shows you need to look closely at your whole benefits package, not just health insurance.
Absolutely. A few more quick ones. Meals and lodging can be tax-free if they're on the business premises for the employer's convenience, and lodging has to be a condition of employment.
Like working at a remote camp.
Exactly. No additional cost services, think empty airline seats for airline employees. If it doesn't cost the employer much extra, it can be tax-free.
Okay.
And working condition benefits. If your employer pays for something you could have deducted as a business expense if you'd paid yourself like a trade journal subscription.
Then it's not income.
Right. It's like they're covering a business expense for you pre-tax.
So the big message here for everyone listening is check your W-2 carefully, understand what's been excluded, see what benefits you have. It's a gold mine.
It really is. Now, shifting gears slightly, stock compensation. This gets really interesting, especially if you receive equity.
Yeah, stock options and things. How does that work tax-wise?
It really depends on the type of option. Let's start with non-statutory stock options. Usually you don't have income when they're granted, assuming they don't have a readily determinable value.
Which is common.
Very common. So the taxable event happens when you exercise the option and it's substantially vested, meaning it's really yours. That income, the difference between what you pay and the market value, shows up on your W-2.
And when you sell the stock later.
That's a separate event. You report the sale, usually a capital gain or loss on Schedule D. Your starting point, your basis, includes what you paid plus the amount you already recognized as income at exercise.
Okay, that makes sense. What about the other kind, statutory options?
Right, statutory stock options. These are mainly incentive stock options, or ISOs, and employee stock purchase plans, ESPPs. And here's the big deal. Generally, no income tax when granted or when exercised.
Wow, none at exercise. That's huge.
A major tax deferral strategy. You typically only pay tax when you actually sell the stock you acquired.
Okay, but I feel like there's a catch. I've heard about AMT, alternative minimum tax.
You are right to be cautious. ISOs in particular have an AMT twist. While you avoid regular tax at exercise, the bargain element, that difference between the exercise price and market value, is counted as income for AMT purposes in the year you exercise. So you might not owe regular tax then, but you could suddenly owe AMT. It's complex.
So it's more deferral than elimination sometimes.
Often, yes. And another key thing for both ISOs and ESPPs, holding periods. To get the favorable long-term capital gains rates when you sell, you have to hold the stock for a certain period after exercise and grant.
If you sell too soon.
Part of your profit gets treated as ordinary income, taxed at your regular higher rate. So holding long enough is usually the goal for tax planning.
Right, lock in those lower capital gains rates. What about qualified equity grants? Heard of those?
Yeah, relatively new. Since 2018, for certain employees at eligible private companies, they allow you to elect to defer income tax on the stock you receive for up to 5 years from vesting.
5 years of deferral. That sounds powerful.
It can be, but it's specific. Lots of rules, and you need to file an election with the IRS within 30 days. Niche, but good for some startup.
Okay. And the last piece of the equity puzzle, restricted property. What's the deal with the 83B election?
Right, restricted stock or property. Usually you don't pay tax until it vests, meaning the restrictions lapse, like staying with the company for X years. The risk of forfeiture is gone.
So you wait until it's really yours.
Typically. But the Section 83B election flips that. It lets you choose to pay ordinary income tax on the property's value when you first receive it, even with the restrictions.
Why would you do that? Pay tax sooner.
It's a strategic gamble. If you strongly believe the stock value will skyrocket,
Aha.
you pay tax on a potentially much lower value up front. Then all the future appreciation, when you eventually sell after vesting, gets taxed at potentially lower capital gains rates.
But if the stock tanks,
You pay tax on value you never got. High risk, high reward. And again, strict deadline. File the election within 30 days of receiving the property. Oh, and dividends on restricted stock. Normally compensation income, unless you made the 83B election, then they're just regular dividends.
fascinating stuff. So many layers to employee compensation.
Okay.
But broaden out. What about income beyond the regular job? And importantly, ways to reduce tax there,
Absolutely. Lots happens outside the W-2. Think business and investment income.
like side hustles.
Could be. Renting out personal property, maybe equipment. Report that income and expenses usually on a business schedule. Royalties from books, patents, oil and gas, generally Schedule E, unless it's your main business, then Schedule C.
And partnerships or S-Corp.
Pass-throughs. Your share of the income flows through to your personal return, usually on a Schedule K-1, even if you didn't actually receive the cash. You pay tax on your share regardless.
Important for small business owners to track. Okay, what about sickness and injury benefits?
Big area for potential non-taxable income here. First off, if you paid the premiums for an accident or health plan with after-tax dollars,
The benefits are tax-free.
generally, yes. Workers' comp for job-related injury or illness, totally tax-exempt.
Good to know.
Compensatory damages for physical injury or sickness, also not taxable. Emotional distress damages get tricky, usually taxable unless they stem directly from that physical injury.
Subtle distinction there.
Very. And qualified Medicaid waiver payments for in-home caregiving, often excludable from income. Big relief for caregivers.
That is significant. Okay, miscellaneous stuff. Bartering.
Taxable. If you swap services or goods, the fair market value of what you receive is income.
What about canceled debt? I owe money, then poof, it's gone. Is that income?
Generally, yes,
Yeah.
surprisingly. Cancellation of debt is usually taxable income. But
Fine.
but here there are major exceptions. This is a huge tax-saving area.
Okay, what are the exceptions?
Debt canceled in bankruptcy. Debt canceled when you're insolvent, meaning debts exceed assets, but only up to the amount you're insolvent. These are lifesavers.
Huge. What else?
Student loans. A lot of student loan forgiveness might be excluded from income, especially under recent provisions running through 2025 or for certain public service forgiveness programs. Also, some employer student loan repayment help is tax-free.
That's been massive news.
Absolutely. Also, PPP loan forgiveness from the pandemic, tax-exempt income, but you need to attach a statement. Some mortgage debt relief on your main home can also be excluded.
Lots of relief there. What about life insurance payouts?
Proceeds paid due to the death of the insured, generally not taxable. Big relief for beneficiaries. Any interest earned on those proceeds is taxed, though.
Okay.
And accelerated death benefits if someone is terminally or chronically ill and receives benefits early. Those can be excluded, up to a daily limit for chronic illness, $410 a day for 2024. Helps cover care costs tax-free.
Vital support. What if you get a refund for something you deducted last year? A recovery.
You only include it in income if, and to the extent that, the original deduction actually saved you tax in that prior year. It's called the tax benefit rule.
Prevents a double dip.
Exactly. And finally, the gig economy. Selling stuff online, driving for a rideshare, all that income is reportable, whether you get a Form 1099-K or not.
And the 1099-K threshold changed.
For 2024, it's planned to be $5,000, so more people might get one. If you sell personal stuff online at a loss, like old clothes, for less than you paid, you report the income, but then you deduct the same amount, so it nets out to zero tax.
Good tip for online sellers.
Yeah.
Wow, this really drives home that you need to track everything, even things that feel like free money or just getting your money back.
It prevents overpaying, absolutely. And let's quickly cover some other key non-taxable items. These usually don't hit your tax bill at all.
Okay, let's hear them.
Public assistance, like welfare based on need, disaster relief payments following federal disasters, wildfires, the East Palestine derailment generally excluded, housing assistance from various government programs,
Essential support.
Medicare benefits, SSI, supplemental security income. Regular Social Security might be partly taxable depending on your other income, but SSI isn't. The Alaska Permanent Fund dividend, this one's tricky. It is fully taxable federally for 2024. Common mistake.
Good clarification.
Alimony received under divorce agreements made after 2018. Generally not income anymore for the recipient. Big change. Child support. Never income.
Right.
Cash rebates from manufacturers.
All right.
Not income, just reduces your cost basis. Gifts and inheritances. Generally tax-free to receive, though income the inherited property earns later is taxed.
Makes sense.
Interest on qualified savings bonds used for education? Excluded. Non-taxable prizes, if you didn't enter, don't have to do anything and give it directly to charity. Not income, or just refuse it.
Wow.
529 plan earnings used for education. Tax-free. Qualified scholarships for tuition and fees. Tax-free. Volunteer, firefighter, EMT benefits up to $50 a month and tax rebates. Excluded.
That's a huge list of things that don't add to your tax burden. Phew! Okay, that's a lot to digest. But it underlines why keeping good records for both taxable and non-taxable stuff is so vital, especially with things like stock options where bases can get complicated, right? Regular tax versus NMT.
Absolutely critical. And remember, those forms we mentioned, W-2s, 1099s, they guide you on where things go on your return. Wages generally on the main form, self-employment on Schedule C, rental Schedule E, miscellaneous stuff usually Schedule 1.
And keep an eye on changes, like that 100% meal deduction being gone and the lower $5,000 threshold for 1099-Ks in 2024.
Exactly. Stay updated. And don't forget resources. IRS.gov is packed with info, plus free tax prep like VIDA or TCE if you qualify, and the IRS direct file option.
Great resources. Don't leave help on the table.
So wrapping this up, understanding all these income sources, what's taxed, what's not, it's not just about filing that return once a year. It's really about better financial planning all year round.
That's the perfect way to put it. Honestly, understanding what isn't taxed can sometimes have a bigger impact than knowing what is. It completely changes your perspective. You stop thinking just about paying up and start thinking about, how do I optimize my financial picture?
From obligation to opportunity. Precisely. This deep dive really shows that tax season isn't just about liabilities. It's loaded with potential opportunities you might be missing to manage your money better and, well, keep more of it.
A fantastic thought to leave everyone with. Go out there, use this knowledge, and take control of your financial future. And definitely send us your ideas for our next deep dive. Thanks for joining us.